Hi everyone, welcome back to Canada Accounting Insights. Today we're tackling property, plant, and equipment, PPE. It's one of the most important areas of financial reporting. Whether you're preparing for your CPA exams or working in practice, you'll definitely see it. Before we dive in, don't forget to like this video, subscribe to the channel, and hit the notification bell so you don't miss any of our tutorials. Alright, let's start at the foundation. Under IAS 16, PPE are tangible assets that are used in the production or supply of goods and services, rental to others, or for administrative purposes, and expected to be used for more than one period. In simpler words, PPE are the long-term assets that help the business run: land, buildings, machinery, furniture, and vehicles. Now that we know what PPE is, the next logical question is, when do we actually record it as an asset? An item of PPE is recognized when it's probable that future economic benefits will flow to the company and the cost can be measured reliably. Think of a delivery truck. It's going to generate benefits through deliveries, and its cost is clearly measurable. Both boxes are ticked. All right, but what if that truck came bundled with land and a building? Let's explore how those are treated differently. When land and buildings are purchased together, we can't just lump them into one account. Land usually has an unlimited life, so it's not depreciated. Buildings, however, wear out over time, so they are depreciated. Example: if a company buys both land and a warehouse for $1 million, and appraisals show land is $400,000 and the warehouse $600,000, we split the cost accordingly. So once we know what counts as PPE and how land and buildings are split, the next step is figuring out, how do we measure it when it first comes onto the books? At initial recognition, PPE is measured at cost. This includes purchase price directly attributable costs like delivery, installation, or site preparation, and estimates of dismantling or restoration. Example: if you buy machinery for $100,000, pay $5,000 for delivery, $3,000 for installation, and expect $2,000 for dismantling, the total cost is $110,000. But sometimes a single asset isn't just one thing. It's made up of many important pieces. That's where componentization comes in. Under IFRS, if an asset has parts with significantly different useful lives, each part must be depreciated separately. Example: an airplane's engine might last 10 years, while the interior might only last 5. Each is tracked and depreciated on its own. ASPE, on the other hand, allows but doesn't require this. Now that we've got cost figured out, let's talk about what happens after recognition, the ongoing measurement of PPE. After recognition, IFRS offers two models. Cost model: keep PPE at cost less depreciation and impairment. Revaluation model: remeasure at fair value, less depreciation and impairment. ASPE: it sticks with the cost model only. And since depreciation came up again, let's take a deeper look at how it works. Depreciation spreads the cost of an asset over its useful life. It depends on three things: cost, residual value, and useful life. Common methods: straight line, declining balance, and units of production. Example: a $50,000 machine, residual value $5,000, useful life 5 years, $9,000 straight-line depreciation each year. But what if instead of buying PPE, the company decides to build it? That changes the calculation a little. When companies build their own assets, cost includes direct materials, direct labor, overheads directly linked to construction, and, if applicable, borrowing costs. But any abnormal waste is excluded. And speaking of small pieces and parts, what about spare parts or standby equipment? If spare parts are consumed quickly, they're inventory. But if they're large, long-lasting, or tied to PPE, they qualify as PPE. Example: screws for a machine, inventory, a spare turbine for a power plant, PPE. Now, since we mentioned borrowing costs earlier, let's expand on that. Under IAS 23, borrowing costs directly attributable to building or acquiring a qualifying asset must be capitalized. A qualifying asset is one that takes a long time to be ready, like a factory. A SPE allows capitalization, but it's optional. Example: if interest of $100,000 is incurred while constructing a plant, that interest becomes part of the asset's cost. Now let's switch gears to a special category: bearer plants. Bearer plants are living plants, like apple trees or grapevines, that produce crops over multiple periods. They are treated as PPE, but the fruit they produce is accounted for under agriculture standards. And what about natural resources like mines or oil fields? Those follow a slightly different rule: depletion. Instead of depreciation, natural resources use depletion. Depletion spreads the cost over the resource extracted. Example: a $1 million mine expected to produce 200,000 tons of ore equals $5 depletion per ton. But as assets age, they eventually need work. So how do we decide if costs are capitalized or expensed? Repairs and maintenance keep an asset working. It's an expense immediately. Replacements or betterments extend life or improve capacity. Capitalize as PPE. Example: repainting a building, expense it. Replacing the roof with a stronger one, capitalize it. But sometimes it's not about repairs. It's about recognizing if the asset has lost value. That's where impairment comes in. If an asset's carrying value is greater than its recoverable amount, it's impaired. Recoverable amount equals the higher of fair value, less costs of disposal, or value in use. The asset is written down, and the loss goes to profit or loss. And once an asset no longer provides benefits or is sold, it's time to derecognize. PPE is removed when disposed of or no longer useful. Any gain or loss equals proceeds minus carrying value. Now, before we wrap up, let's highlight some of the main differences between IFRS and ASPE. Measurement: IFRS allows cost or revaluation. ASPE only cost. Componentization: required under IFRS, optional under ASPE. Borrowing costs: IFRS requires capitalization. ASPE allows choice. Impairment: IFRS allows reversals. ASPE does not. Bearer plants: IFRS includes them as PPE. ASPE doesn't. So, to bring it all together, PPE includes everything from land and buildings to machinery, spare parts, and even natural resources. We measure at cost, allocate through depreciation or depletion, assess for impairment, and derecognize when it's gone. IFRS and ASPE share the foundation, but differ in key details like revaluation, impairment, and borrowing costs. If this video made PPE clearer for you, give it a thumbs up, subscribe to Canada Accounting Insights, and comment below with the next topic you'd like me to cover. Thanks for watching, and I'll see you in the next video.